like that, you know. So
And it
get
can
the
be more
head
sinister as well. Dolores McNamara, the first Euro Millions winner in Ireland, there was a threat made against one of her sons by a gang in Limerick, and a ransom was the end goal for them. So you invite a lot of scrutiny by going public, and you kind of have to be discreet even if you decide to be private. If you suddenly buy that new mansion up in the Slieve Blooms and you've got your Ferrari up and down the road every day, people are going to talk.
When the neighbours see a gold-plated hot tub being delivered into the number 4 Cherrywood or wherever it is, Will, you know, you have to be private and you've got to be clever with it as well, you know. So I would say get your head straight. You know, money doesn't change. It won't change your temperament. And the temperament that's required now is coolness, calmness. Yes, you're wealthy. Your financial future is sorted, but calm and relaxed is a temperament and an emotion that doesn't really come to it. It's excitement, it's joy. And yes, you want to jump up and down, you want to celebrate, you really want to take all that's good with this. But there's a few jobs along the way now, Will, that have to happen, and they are going to require a cool, calm head. Like the first thing, the second thing I say then is get a team around you. Now, you don't have to skimp on this team. You know, you need the best solicitors. You need the best accountant. You need the best financial planners. So I'm not going to give a cheeky plug for ourselves here in TrueWealth, but I am also. You're not just a lotto winner now, Will. You're an actual financial entity. This money is going to generate an interest alone. You know, it'll generate between 7 and 8 million of interest alone at 3%, ignoring taxes on it, Will, just to keep the number straight. So you'll need a legal structure. You'll need to protect your identity, and you're right. You know, if it does get out, it can get nasty fairly quick. We all know the stories of the family's inheritance losing relationships off the back of it, and people never being the same again after money. So money won't make you happy. It'll amplify more of what you already are. So it's time to do, you know, at this time, this person, yes, celebrate. Yes, I don't want to get on and, you know, and be miserable about it, but it's to also do the right thing so that you can maximize on what this is going to do for you in your life. So, you know, the tax strategy is going to be important. 250 million euros is the biggest beneficiary could end up being the revenue if things are not done in a financial planning mindset way. So, you know, this team
I often
of people,
think of Warren Buffett, a man that you and I have spoken about on this programme, widely regarded as the world's best ever investor. And he is only coming to retirement age now, despite being one of the richest men in the world. And his retirement age is 95 in August. So that kind of shows that because you come into money doesn't necessarily change your needs for purpose and to be busy and so on.
Will, it's so important. It's such a great topic to bring up, because if you lose your purpose and you lose your routine, like what's more important than your health and your well-being and your mental health and your mindset? So we all know the stories of what money can do to people. I hope the winners, it also changes, I suppose, the way people look at you. So there's one way to look at you looking outwards at the way, you know, you might behave or the way your temperament might be, but through no fault of your own, you know, just because you bought the ticket and you won, people will look at you differently now. So in this team of people, you need a really good gatekeeper, a filter, somebody to block out all of that noise. Life is definitely going to change, you know, significantly for this person. Once you hire those great people in that team, that close-knit team, you let them do their job. And then you think about calmness and peacefulness and inner peace and happiness, and then go on the holidays and do all of the things. What good is any money to anybody if you don't have the health and well-being to enjoy it? When I think the Lotto, that's what I think.
Let's come on to us mere mortals who have not won €250 million, but you may have squirreled away your savings over the years, invested wisely. Perhaps it's the small business owner, such as we talked about the last time, and you want to give as little as possible to the taxman and as much as possible to the next generation. And that brings us, first of all, to the small gift exemption. What that?
Yeah, so, the small gift exemption is it's the simplest, and it's very much underused, Will. And I don't like to say that because it allows any individual to pass on a sum of money, up to €3,000 per year, completely tax-free outside of the capital acquisitions tax net. So and the common one is parents passing on to the kids then, which is the normal one. Okay, so you have to think about the receiver of the gift. They have to document where the gift came from. You can't rock up and buy your house, unexplaining 10 years of €3,000 a year or €5,000, whatever the gift may be. So you can document this, and each parent can give the 3,000, Will. So
when you say
6,000,
document it, so that's more than just leaving it on your bank statement and having to search back. You should probably diary it, should you?
Has to be documented, and in a particular savings plan is the safest and neatest and tidiest way to do that. Add in a little bit of growth, then, Will, in the right type of savings plan, protected, low risk stuff you can use for these type of. They're called the bear trust, which we're going to get into, but it's well documented in that case. Then each parent can give the €3,000. That's €6,000 you can give to a child. 3 children, you're passing on €18,000 a year. Now, look, it's relative to everybody's level, Will, of income and what wealth they have to pass on. So if that's €1,000, so be it €1,000. But there's no point in landing on the gift down the road when the house comes up and you want to help the kids. This is about seeing, you'll hear me harping on, everybody's sick of me harping on now at this stage about seeing these things far out. But I just want people to pay as little as they can, pay the tax legitimately that they have to pay, but as little as they can. So you can gift any value of anything up to €3,000, like an investment or any type of product or shares, would say. Okay. And as long as the market value is documented on that gift, then you're safe in that you won't go into the capital acquisition tax threshold.
Yeah, so let's say you donated Apple shares, for instance, worth €3,000 today, but in a year's time they're worth €4,000. It's the point at which they were transferred that is the threshold.
The 3,000 is protected, so you're not eating into the capital acquisition tax. Now, any growth then on the shares and on the savings plans, which we'll get into there, would attract normally the exit tax, which is normal. You're going to pay that anyway. Okay, so but the exit tax will be charged in the hands of the receiver. Yeah. So the child will say in this instance. So
the parent
just paying
liable
tax
beyond the point at which they've made the transfer. Can I just point out another possible benefit as well? We talked a lot about fair deal earlier. If you're whittling down some of your assets, and there is a look back period of 5 years on fair deal, but if you plan sufficiently far in advance, it can be beneficial there too.
Absolutely. And the look back is where a lot of people get caught out, Will. In financial planning, you're looking at the particulars. It's like the dwelling gift exemption. Some people think that they qualify for the dwelling gift exemption where the home house can be passed on outside of capital acquisitions tax, but there's criteria that have to be met. Same as the fair deal scheme. There's a 5-year look back, which catches an awful lot of people. So planning for this doesn't start 5 years from that point. It starts today, and the next best time is yesterday and further back. So, but in the case of these bear trusts, I suppose I'd love to see parents using these bear trusts, putting this gift, documenting it aside, particularly if they know they're going to have an inheritance that's going to cause a tax bill down the road. So the bear trust can be documented each year to 1, 2, 3, as many children as you want. It's for anybody. You can go to friend, neighbor, foe, whatever. So so the investment then in the bear trust itself then is owned by the child until 18 years of age, but the giver of the the funds then is in control of that trust until the 18-year-old can obviously use the money. So yeah, but it's a very useful tool for people that want to maximize on the amount of money that they can pass over. If you think about over 10 or 20 years, Will, if it's 12,000 a year you pass to between three kids, it is you can pass over 120,000 over 10 years or 250,000, and there's no tax, no revenue dipping their hands into your inheritance. So it has to be maximised and it has to be used if it's set up correctly. And then, depending on your investment preference, so your appetite for risk and your proportionate to what you want to take. So you could set it up in some company shares, in equities, in bonds, cash, gold, a well-diversified fund proportionate to your risk tolerance. A return of, say, if you put away over 10 years, 60,000, a return over 5%, then your 60,000 has grown to 80,000 euros. So not only are you saving and avoiding tax, it's like a double win. So you're saving, you're avoiding tax, and you're actually adding to that then for the receiver. So it's a very, very clever way to pass money on. And look, it's while you're alive as well, Will. So there's good heart in it. It's not on the debt when it's you'd like to be able to see your loved ones enjoying what you're passing on as
Absolutely,
well.
Absolutely, yeah. If you have the means to, and not everybody will, of course, but it might be useful to have a concrete example, Shane. So think of one, and we'll come back to it in a moment.
Midlands Today
with Bus Éireann. Travel on Bus Éireann services A1 and A2 in Athlone Town for connectivity to college, bus and rail services as part of the Transport for Ireland network. Visit buséireann.ie for timetable information.
Shane Tobin is the oracle from TrueWealth.ie. And let's use an example of, fictional John and fictional Mary, and they want to minimise inheritance tax to their two children. What does this look like, Shane?
Yeah, so John and Mary can give each of the children, they can give them 6,000 euros a year, so 3,000 per parent. That's 12,000 euros per year, and over the next 10 years, if it's college or whatever they're saving for, they will have passed on 120,000 euros outside of the tax net, not eating into the capital acquisitions tax, the inheritance tax. So they can then pass on the family home or whatever assets they have later on when they pass on, and they'll have full use of the capital acquisition tax limit for them. Now, in this case, they set up a bare trust savings plan, risk appropriate, modest growth, 10 years, like I say. If it earned 5%, and I'm being very modest with the 5%, you're always aiming for around 10% with these funds. That 60,000 will have grown to 80,000 euros per child. That's 160,000 then. 160,000 will have passed on. Now you'll pay tax, as I say, on the difference between 120,000 and 160, but that's fine. It's not money you had in the first place. It's just exit tax on growth that you've earned. But really clever, and urging everybody to think about this now, particularly when the kids, they start to turn, 4, 5, 6, 7, 10 years of age. College is a big one. Housing is huge. They're going to need help. And, the wedding gifts and in getting on in life then as well. You want to be able to document as well. You can't just arrive on with if you arrive on with 10, 20, 30, 50,000, it's a tax issue. So it just takes planning for Will.
Here's a curveball from a listener. If you pay your child's college fees, is that a gift?
Yes, depends on the amount that you pay then. So if it's under 3,000 euros per year, nothing to worry about. If it's over, should be documented and it should be recorded. And that will bring a tax issue.
Now we talk about
or else the person will eat into their capital acquisition tax limit, if that makes sense.
Yes. But either way, keep the record of it. We talked some weeks ago about different insurances. So is there a way you can mitigate your inheritance tax liabilities through policies?
Yes, there is. And a good financial planner will always talk about the words diversification. They will always say spread the risk, not all the eggs in one basket. I'm going to give you a couple of examples here that can add now to the small gift exemption. There are other things, very complex things like holding companies and family partnerships, which we can get into another day. But a simple Section 72 life insurance policy can be taken out, ring fenced then, if let's say the benefit is €250,000 or 500,000, and be specifically ring fenced, to pay the inheritance tax that would arise on the passing of that person. So it doesn't add to the inheritance, it takes away the inheritance tax bill. Now it's paid for by the individual that passes on. It is revenue approved. It's very simple. And that could be one part of the overall plan to avoiding inheritance tax. I know, Will, we all work very hard to earn the money. I wouldn't like to see any money that I'm passing on to my estate. I wouldn't like to see it going to the revenue unnecessarily. And that's just one angle and way to avoid against that.
So that's Section 72. What's a Section 73 plan?
Yes, and this is my favourite part of it, because you want to pass it on when you're alive and when you're well, and you can see them enjoy the gift. So a Section 73 plan it's the same thing. It's an investment based savings plan. It's held for a minimum, and has to be held for a minimum of 8 years. Now it's used to gift wealth when you're alive. So, and the plan itself is used while you're alive to pay the inheritance tax, the capital acquisitions tax that is generated from off the back of that gift. So you want to gift your child 50 grand towards the house or to the wedding present or whatever it is. If that's going to trigger a capital acquisition tax, this savings plan, the accumulated value of it, if it's structured correctly, can pay then the capital acquisition tax. Has to be in place for 8 years before it becomes taxable. You pay the premiums into a regular investment plan. Like we said, Will, the equities, bonds, cash, property, that's all designed in a financial plan. And when you cash it in, the proceeds can be used then to pay the inheritance tax. So if the child, you want to gift the house when you're alive, the house is worth €500,000, but you have the Section 73 plan, savings plan built up, covering 33% of the value of the 500k property valued home, then you've handed over the house and the means to allow that person to actually keep it. You might have Section 72 and Section 73 policies in place to mitigate against these things, using the small gift exemption, and then you're doing everything you can then to mitigate against inheritance tax.
Our time is almost up, Shane, and I'm conscious for some people the coffee just wasn't strong enough this morning. There are complexities in this, and it's great to have somebody who has the knowledge to guide and advise and to mentor. Final word?
It doesn't have to be complex, but it can be made complex by people. Money should make life simple. I don't want anybody out there that has money and has wealth that they've worked and given their health to earn, even to make things overcomplicated. And I don't want them to stress, and I don't want them to worry either. The whole reason you earned it, so that you could have a good, healthy, peaceful life and enjoy your family and your loved ones and everything that's good in life. So financial planning, that's why we do True Wealth. That's why we love this business so much, Will. And it just takes forward thinking and forward planning. I hope that helps.
Shane Tobin, thank you very much for your time today.
Thank you, Will.
Shane is Chief Executive of TrueWealth.ie and indeed LowQuotes.ie, based in Portlaoise.